Hello everyone, welcome. My name is Valery Nikolaev and this is Financial Accounting. So this is our first video, and in this video we'll talk about objectives of financial accounting. We will talk about GAAP and types of financial statements that we will see throughout the quarter. Okay, the objective of financial reporting is to facilitate decision making by external parties, right? These external parties could be shareholders, could be creditors, could be employees or analysts or say competition authorities or financial regulators such as banking regulators and so on. They're all interested in their own decisions, but for these decisions they would like information about firms' resources, about firms' economic performance, and of course ultimately pretty much everyone is interested in understanding firms' ability to generate future cash flows. Okay, it's important to understand that this is the objective because accounting rules can be written in many different ways, and it's actually very easy to write accounting rules in a way that's very bad for decision making, right? So that's why this is the guiding objective when standard setters are trying to make accounting rules. Okay, what are the properties of decision useful information? Well, information should be relevant for your decisions. It should be reliable. That is, we have to be measuring it with a certain degree of accuracy. It should be comparable across firms, and it should be comparable over time so that we can easily compare firms with each other and over time and so on, right? How is the objective, which is decision usefulness, achieved? The objective is achieved through generally accepted accounting principles, or GAAP, right? GAAP basically is a set of rules, large set of rules, maybe 20,000 pages or so. And what these rules do, they basically convert a vast quantity of economic transactions into a relatively few simple numbers reported on the face of financial statements, so that we can kind of take these numbers and make our decisions. Okay, so that's what GAAP does. Now, who creates GAAP? It varies depending on whether we're in the United States or in some other country. So in the United States, ultimately the authority to write and enforce accounting rules lies with the Securities and Exchange Commission. Okay. Securities and Exchange Commission keeps the enforcement function, but it delegates rulemaking function to Financial Accounting Standards Board. It's a private sector body represented by private sector members of the board who basically are closer to companies, who know better the issues, and as a result they are better and more capable of writing high quality accounting rules. Okay. In each country, there are own bodies that enforce accounting rules and accounting standards, and each country, in principle, has their own GAAP. Like there's German GAAP, there's UK GAAP, that followed typically by small companies, but larger international companies follow something that's called International GAAP or IFRS, International Financial Reporting Standards. So nowadays, more than 100 companies in the world adopted international accounting standards, and United States is not one of those countries. We don't have IFRS in the United States. We follow US GAAP, not international GAAP. US considered whether to adopt IFRS, and they decided against it because they're pretty happy with their set of accounting rules. Okay, so what are the key financial statements that we are going to learn about, right? Let's just introduce them before we talk about each of them in details in future videos. Okay, so we have balance sheet, income statement, statement of cash flows, statement of comprehensive income, and statement of changes in shareholders' equity. Balance sheet, or statement of financial position comes with balance sheet equation, which says assets equal liabilities plus shareholders' equity, or economic resources equal claims against those resources. Balance sheet stands out from all other statements in that it is a statement that is prepared at a point in time. It describes the company at a point in time, like a snapshot, whereas every other statement tells you how company evolved over a period of time, what happened over a period, how much money earned for a year or for a month or for a quarter, and so on, right? So income statement tells us about how well the firm did in terms of its economic performance, right? Net income equation is revenues minus expenses, and we'll talk about those concepts in more detail. Cash flow statements tells us what were the sources and uses of cash during the period, right? Cash could come from operating activities, it could come from investing transactions or financing transactions, and so those three basically make up total cash flow. We have statement of comprehensive income, which is somewhat more technical statement. It says that comprehensive income equal net income plus other comprehensive income, right? So what is this other component? It is basically unrealized gains and losses that accountants view as kind of temporary, and for this reason they are not included in the income statement, right? They are likely to reverse in the future. They are too uncertain. Statement of changes in shareholders' equity is a kind of less important and more mechanical statement as far as this class is concerned. We will not talk much about it because if you know what's going on in the balance sheet, income statement, and cash flow statement, then statement of changes in shareholders' equity is kind of redundant to an extent because it tells you basically where the firm generated earning. I mean, it tells you why shareholders' equity changed, and that, of course, is because firm generated net income, firm paid dividends, as you can see in statement of cash flows, or firm repurchased some shares, which is also you can see in the statement of cash flows. And there are some technical transactions sometimes, like, say changes in accounting rules that sometimes affect shareholders' equity, and this is sort of something that could be useful, but this is a little bit sort of too advanced for us to talk about within this class. Anyway, of course, beyond these 5 financial statements, there's a lot of other useful information in annual reports. Most notably, there are notes to financial statements that give you a lot of information about how to read numbers in the balance sheet and income statement and so on, right? They tell you about what assumptions accountants follow, they tell you about what methods were used to prepare numbers and so on. Financial statements are basically the centerpiece of annual reports and quarterly reports. Where can you find them? Securities and Exchange Commission requires that companies file those periodically with Securities and Exchange Commission. You can see that on SEC's website. You can search any company. You can also find them on companies' own websites dedicated to financial reporting. These reports have standard structure, right? They tell you, for instance, about business model and risks associated with business model. As a first item, they give you narrative discussion of operations, and they also give you financial statements, of course, and notes to financial statements. Firms are not limited in how much information they want to report, right? So many firms provide additional information voluntarily via press releases, via conference calls, via management guidance, and so on. Okay, so this gives you a pretty good idea of what are the objectives of financial reporting and sort of how firms communicate with the outside world. And in the next video, we'll talk about balance sheet and how to construct it.